Now we're going to the income statement. Like, did you earn any profit and how? So we notice that there are levels. Again, statements are structured a certain way. We have net income of $53 billion for Apple. That's the bottom line. Top line is $233 billion. And then we have gross margin, which is the net sales minus cost of goods sold. We have operating income, which is just the gross margin or gross profit minus operating expense. Then we have pre-tax, and that is after we pay the non-operating items like interest or some other items that don't have anything to do with running the business. We'll, again, cover those later on. And so we have subtotals that help us analyze profit. So here's an accounting question that illustrates this fundamental idea of accrual. So let's say that Holt hired some painting contractors last month in August. And the painting contractor is called APC. And they were asked to patch and paint the classrooms, meeting rooms, and hallways. They finished their work on August 29, and let's just say it's done perfectly. And they didn't bill the work to Holt until September 15. And Holt pays the bill on September 30. So what should the financial statements look like or show on August 31st? And what should it show as of September 30th? I'll give you a moment just to think about it. So what do we record and when on this? All right, so you may or may not know the answer, but here's how you would think about it. Under accrual accounting, we recognize revenue when it is earned, and we recognize expenses when it's incurred. Right? So the key word for expenses is the word incurred. So as of August 31st, did somebody do work and did we actually incur an expense? And if I asked it that way, I'm leading you to the answer is yes. Somebody came in here under a contract, did a lot of work. They finished the work, so I owe them. You know, on that day, as of the end of, I owe them. They didn't bill me, but I owe them the money. Let's say it's $10,000. I owe them $10,000, right? Well, what about September 15? Well, that's when they got around to billing me. So as of September 15, I know how much they're charging me, $10,000. So in accounting, what we would do is say, as of August 31st, we owed the $10,000, and we would show as an expense for repairs, and we show a liability, an accounts payable to the painters for $10,000. So that's accrual accounting. We didn't pay it. We didn't even get the bill, but we know it. We can estimate it. It's $10,000. So under GAAP, we must record it as an expense that we know that we incurred in August. So how about September? Well, as of September, we paid them off. So as of September, there's no expense for the month of September because we already expensed it in August. And then there's no liability remaining as of September 30 because that bill that we got and recorded on the 15th, we now paid off. So as of September 30, we're done, right? The money is out. We got rid of the $10,000, went to the painter. The expense is fine. We recorded expense of $10,000, but it didn't expense in September, expense in August. So the mechanics of accounting make all that happen. How? We record an expense on an accrual basis of $10,000 in August. It's an expense and a payable. And then in the month of September, we pay off the liability. So we reduce the payable and we reduce our cash. We'll go through accounting transactions in next session's video. But this is an example of accrual, this idea of recognizing revenue when earned and expenses when incurred. That's a core GAAP principle. This is just what I would describe. Accrual accounting is we recognize revenue when earned, and this is an example of the other side, right? If you're the painter, when you finish the work and it's perfect, you've earned the money, right? And expenses is when incurred. That's when you owe something, somebody's done something for you, or you've received goods that you have to pay for. That's something which is incurred. Operating versus non-operating. Operating are those that are ordinary and customary in running your business. So in a product business, cost of goods sold, selling expenses, depreciation, R&D, these are normal things that a company would spend to build its business. Non-operating, as the word implies, are not from running the business, right? Non-operating. So what are they? Interest expense. Well, time out. Like, interest isn't debt and interest a reality of life? Answer, no. The reason it's not a reality of life is, let's say you need $100,000 to start your business. You could go to your rich aunt and have your rich aunt invest $100,000 in your business. In which case, you don't owe anybody interest at the end of next month because it's all stock, right? You sold 100,000 of stock to Aunt Wilma, and at the end of next month, you have no interest expense, right? On the other hand, you don't have a rich Aunt Wilma. You go to Bank of America or Bank of America, and they loan you $100,000 at 10% or 12% per year, let's say. So after 1 month, do you owe any money to the Bank of America? Yeah, you owe 1% of $100,000, so you owe $1,000 in interest. So where does it go? Well, it's an income statement, it's an expense. Is it an operating expense? Answer, no. It's not an operating expense because it was an expense that you incurred because of your financing decision to borrow money and not sell stock. So many, many times you're going to have this kind of confusion that students typically will have on things that you have to think through one level deeper. In this case, interest expense, even though it is a kind of fairly common, it's not an operating expense. It's a non-operating expense. Same thing with when you get on the inbound side. Let's say you have extra money lying around, and rather than have it sit in the bank in a checking account, you buy stock or you buy a bond. Well, and that stock pays a dividend, or that bond pays you an interest. Is that your revenue? From running your business, did you earn that money? No, that's not your business. You just got money because of an investment decision you made. So again, that's non-operating. In this case, non-operating revenue. The other is gains and losses with securities. So let's say you bought some stock, and 2 months later you chose wisely. Stock price went up. And so when you sold it, you made a profit, a gain on sale of stock. Well, is that normal in operating of your business? No. So it's not operating. So here's where the non-operating is a little tricky, but just if you think about that operating is what is usual and customary for running the business, and anything that's outside that is non-operating, you're okay. All right, discontinued is a technical accounting term, which means when a company, let's say at the board level, decides to exit a business, it can no longer count the revenue or show the revenue on top as its revenue. From that point on, it has to then push all the results of the discontinued operations into the bottom as its own separate little line. And the reason we do that is, let's say we were in a business that had $50 million in product line A and $10 million in product line B. And the board of directors says, you know, this product line B is not making us money, will never make us money, and is not core to our business. Let's get rid of it, right? So from that point on, would you want to show your investors that you're at 50 plus 10 or $60 million in revenue? The answer is no, because on an ongoing basis, going forward basis, you're only going to be growing and investing in the business that is at $50 million. So 50 million remains, and where do you put that 10? The 10 goes all the way down to the bottom, nets against all the expenses of running product line B, and is shown as a one-line discontinued operation income or loss. And that's a very odd thing, I know, because when is revenue revenue, right? It's not a trick question. Revenue is revenue when it's part of your ongoing operating business. When is revenue not revenue? When it's not an operating item, or it's a discontinued business. And that's what we're doing here. Again, we'll look at more of these with real examples, but introducing the idea of a discontinued operation and how accounting has to reflect more of the ongoing, what's going to continue, as opposed to what's not going to continue. Profit is not the same as cash flow, right? To most people, this is a confusing thing. Like, when I make it $100, I made $100. Well, no. If we're using accrual basis, which we have talked about, when we have revenue, we may not have cash, because I'm going to record revenue when we earned it, whether or not they paid me. On the other side, I'm going to incur and recognize an expense whether or not I paid the expense. So profit is on the accrual basis, which has, based on how it works, a difference with cash flow. So we have this idea of we want to analyze the cash flow. We want everything, of course. We want to analyze accrual basis income. We want to understand cash basis cash flow. So what we do is we use shortcuts. We use tools. One of the tools we use is called the cash conversion cycle, CCC. Everything has an acronym. What it means is we buy inventory, we sell inventory to our customer, we collect money from our customers, and then we pay our bills, right? So it's this cycle where we have inventory, we have receivables, and we have payables. And so this cash cycle is how we analyze this kind of different way to look at the results other than accrual basis. All right, so how do we look at this? We have ratios. In this case, they're called average days sales outstanding, average days inventory outstanding, average days payable outstanding. And we'll do the math later on. I just want to show the idea that it takes Apple 26 days to collect money from their customers. It's pretty fast, right? But it's within 30, so that makes sense. Inventory, 5 days. Why? Apple has such high demand that a lot of their products are almost pre-sold. Once they come in, they're sold. So they turn inventory extraordinarily fast. Like normally, if you buy a product for sale, it might take you a month to sell, right? Not in Apple's case. They can sell super fast, sometimes pre-sell. And then payables. How long will a vendor let Apple pay them? In this case, on average, the Apple vendors allow them 85 days. Like, think about that. 85 divided by 30 is like almost 3 months. So someone selling to Apple will say, Apple, I love your business. Pay me in 3 months. And so that's what happens. It takes them 85 days to pay their bills. So the CCC calculation is you take the days sales outstanding plus the days inventory outstanding. That's just adding to time before you get your money. And then you subtract from it how long your vendors give you to pay the bill. And that's why this is negative. It's negative because that plus that minus that is negative 52. Let's look at a more typical company, 3M companies, Scotch tape, stickies, things like that. It takes them 50 days to collect their money, which is not great, but you know, that is under 2 months of 60 is okay. So it takes their vendors about 50 days to pay them. Right, got it. Next is inventory. How long does it take them to sell their stickies and their Scotch tape? About 85 days. Okay. Takes them about 3 months to sell all their products. Again, not ideal, but understandable. And how long will their vendors tell them they could pay? The vendors aren't as patient. They say, no, pay me in 30 days. And they pay in 40 days. So in their case, the CCC is 50 plus 85, which is 135, minus 40, which is about 90, right? So their CCC is 90. So first question, is higher, better, or worse? Answer, worse, because we want to turn cash fast. So the shorter number of days that we turn cash, the better. What does a negative CCC mean? It's very rare, but a negative CCC means that the vendors to the company let the company pay even after they've done everything, like sell and collect all the receivables. Very unusual. Apple gets it. Not many companies have this luxury. And what does a more typical look like? More typical would be it takes 30 to 60 days to collect. It takes 30 to 60 days to sell. It takes 30 to 40 days to pay. And so in general, it's going to be CCC of a positive number, typically in the 30 to 50 range, right? So 3M looks a little slow. Apple looks super fast. That's how we would interpret this.